Thanks for joining us. We have a very exciting chat here with a star-studded roster who really likely needs no introduction, but I'm going to do it anyways. So to my left, to start, we have Haseeb, who is a managing partner at Dragonfly. He spent time as a software engineer at Airbnb before making your way into crypto with Earn.com, which was later acquired by Coinbase. I don't know if it's your spare time, you also spent time as a teacher, writer, and fun fact, Haseeb was also a former professional poker player. and then we have Vanessa, who is a general partner at Aglaé Ventures. She has over 15 years of dedicated financial services experience, spent time at CoinFund, and was one of the first employees at Consensus, helping lead some very critical Ethereum ecosystem initiatives. Avichal, who spoke earlier, he is a successful entrepreneur, having spent executive time at Google and Facebook, which acquired his last company, his startup. And as an angel investor, he's invested in over 15 unicorns, 5 decacorns. I didn't even realize that was a term for the longest time.
It's a new unicorn.
Yeah, right. I love it. And
does it even count if it's not 10 billion?
And he co-founded Electric Capital in 2018, grew it to one of the largest crypto venture funds globally, having invested in many of the leading Web3 companies and protocols we know today. With that, maybe just to start off with the first question, just to set the lay of the land of Web3, we've gone through the wave of DeFi, summer, NFTs, the emerging of gamings. In other words, what kind of pitches are you seeing right now as investors, and where are Web3 builders building?
So it wouldn't be a surprise that ZK is all the rage right now. So we see a lot of projects there on the infrastructure side, whether it's L2s or bridges to ZKs. There's a lot of excitement around the space. We see a lot of new applications, and I have to say not all of them are quality applications. So at the application layer, I think people are pretty new and want to find product market fit, but I think that's where we're heading.
Anything you want to call out?
No. So we see a lot of copy and paste of Web 2 applications trying to get into Web 3, and I think it might be the right time, but we're still not there completely. So that's what I see, and then on the more infrastructure side, a lot of data analytics, trying to bridge the gap between real world data and blockchain data.
Yeah, I'd say from our side, so you talked about ZK. Definitely ZK is a very hot trend right now. I like to say that every cycle, there's a smart person trap in crypto, that if you're really smart, you end up being this is the coolest thing and I should only work on this. Right now it's ZK. So it's what you see all these Stanford PhDs who get bored of aerospace, they decide you know what, I'm gonna do ZK. And particularly ZK hardware is actually for some reason really hot. In 2017, it was consensus mechanisms. Everybody was coming out with a new consensus mechanism, and that was the smart person trap in crypto. So every cycle we have one of these. I'd say the other thing I'm seeing from a lot of founders is that, so it's hard not to notice that we're in a bear market. And in a bull market, I find that oftentimes entrepreneurs are, they're more, they take bigger risks, and they try to tackle bigger products or try to tackle bigger problems. In bear markets, people often feel it's hard to get funding, a lot of people are scared, and so I should try to choose something that's very safe. And so oftentimes, actually, this is the wrong direction to go, but entrepreneurs have a very strong pull toward this idea that I should build something more incremental that I know is going to get revenue, but is going to be a much smaller market. And actually, I think in the long run, it's actually not wise to do that. As an investor, I want to see people tackling big problems, taking big swings. That doesn't mean do something completely crazy they have no shot of succeeding, but I'm seeing a lot more things that are just very incremental. Oh, I'm going to do an NFT marketplace that's slightly different, or I'm going to do a data play that's this, but for an even tinier market than that. And a lot of these things, they can get funding, some funding, but the markets are so small that they're just not really interesting, and they're not going to move the industry forward. So I feel I'm seeing a lot of entrepreneurs playing it safe, but there are still some people who are trying to tackle really big problems, and that's what I'm most excited about.
Do you see also investors taking it safe? I
of
feel
course.
There's that move
100%.
too, so they match.
Right. Yeah, the reality is that since the bear market began, you've had a lot of the marginal capital in the space leaving. right? So a lot of generalist VCs who didn't really know what they were doing in crypto, but they were kind of like, oh, crypto's great, it's the future, blah, blah, blah. They were writing checks in crypto. Now a lot of them have backed off. A lot of the growth guys like Tiger, Coatue, SoftBank, they all kind of bought the top and now they're out. And so because of that, I think people feel that the capital in this space is constricting. But some of this, like, I have this mental model that investors and entrepreneurs, they're constantly, well, okay, this is a bit of a detour. There's this concept in AI of what's called a GAN, a generative adversarial network. And the idea of a GAN is that you have a generator and you have a discriminator, okay? And the generator is trying to come up with like fake examples of the data, and a discriminator is trying to figure out which ones are real and which ones are fake. And that's kind of what we do as investors, is we're trying to figure out which of these entrepreneurs are real and which of them are bullshit artists. And the entrepreneurs are learning from us how to pass our bullshit detectors, and they keep evolving. Like, we're both evolving in response to each other, right? And so when you have one side of the market, like all these generalist VCs totally leave, it kind of disrupts the dynamic a little bit. And entrepreneurs get thrown off, I think, in a way that is unhealthy. So anyway, I don't know. This is kind of a pet theory, but what do you think of Avichal?
For anybody who doesn't know, Haseeb and I are good friends, and then whenever we do panels, I just commit to disagreeing with everything he says. And it just makes for a more interesting panel. And also,
we're not actually good friends.
And the other thing that's really fun about that, actually, for entrepreneurs is there's like a good general rule of thumb. If you ever ask a bunch of investors for advice, you can think of it kind of like a bunch of vectors. There's like some direction and magnitude. And if you ask enough investors for their advice, and then you sum up all those vectors, it basically equals zero. So everybody just disagrees. And so you can't actually, there's like no way to know actually who's telling you the truth. And so it's kind of like a fun exercise if I just take the other side of whatever Haseeb says, both like for me to try to see if I can just make it sound compelling to say the exact opposite of what he says, but also for people to try to figure out what's actually real. So I'll take both two topics. So there's the zero knowledge, and then what was the other one that you said? Oh, people are taking too small.
Yeah.
Okay, yeah.
All bad.
Okay, so first of all, zero knowledge is fucking cool.
I didn't say it wasn't cool. I said it was a smart person trap. That doesn't mean it's not
Here's
cool.
the thing. So what's interesting is the example that he used as the smart person trap was consensus mechanisms, but I would argue actually probably the single best investment decision in 2018 was to invest in all the alt-ones.
We made a lot of them. I
There you
don't
go.
disagree with you. I don't
So
disagree.
therefore, I would argue actually the smart person trap was perhaps actually the smart thing to do. And so, I think zero knowledge, if it actually does change the world, is probably actually the right place to be playing with all the smart people. And then on the small incremental idea, I also think founders, especially technology founders, and especially in a space like crypto, tend to have, there's sort of like two types of errors you could make. You could either make the error that you're way too early, or you can make the error that you pick a thing that feels incremental. And I would actually argue that most founders are more apt to make the error of being far too early because they can see the promise of the technology rather than being too late. So, Facebook was started when MySpace was at 80 million people. Google was not the first social network, the first search engine. Excite had already IPO'd, and so on and so on and so on. And so actually, the history of technology is littered with things that looked kind of incremental-ish because the market was already dominated by somebody big. And so I'd actually argue if you're a technology founder, which probably many of the people here are, they skew technologist, you're more likely to be able to see the future and believe that it's going to show up in 2 or 3 years when it will actually take probably 10 years. And so actually a little bit of incrementalism might actually be the right approach. Boom.
No, thank you. Thank you so much for those inputs. And I mean, Haseeb, going back to your point, and this is a talk I watched or a debate maybe you had with Avichal a while ago, talking about the 5 categories of unsolved problems in crypto, right? You were talking about identity, and I might screw this up, so help me out, interoperability, scalability, privacy, and then there was one more, UX, right?
Yep.
Across those, right, ZK obviously fits into a lot of those categories, but where are we at overall as an industry in solving those problems, and what's the state today? For an open question for everybody.
Yeah, so I think, just going through them one by one. Scalability, we still suck. We got a lot of work to do. People are excited about layer 2s, and I think with there's a lot of progress being made right now, both on Ethereum and on other kind of some of the layer 2 innovation that's going to improve on scalability. Then we also have some of the alt L1s like Celo and the new generation of alt L1s as well, trying to grind on making scalability work better. There's progress, but we're still a long ways away. When it comes to UX still sucks. I haven't seen anything really change in the last year. Interoperability, We just had another gigantic bridge hack just like a month ago. So it seems pretty clear that we're not there yet. We still got a lot of work to do on interoperability. Privacy, I mean, if anything, we took a step backwards with the OFAC sanctions. Now it seems like we're going to have to find a new angle of attack about how to actually get effective privacy for users, especially in DeFi. And then the last one was identity. Do you see identity on chain anywhere? Not really. I mean, there are startups that are trying different things,
right.
But there's no standard. There's no single thing that I'm seeing being widespread adopted anywhere. I'm excited to see it happen, but we're still in the very early innings. So these are all gigantic problems that there's so much white space on how to solve them. And I think generally speaking, when you're in a bear market, it's solving those really big problems that opens up the tech tree that enables the innovations of the next bull market. And that's kind of, I think, what our task is for the next year or two. While macro is kind of crappy, while everyone is quiet, while
right.
no one's paying attention to this stuff, we have to solve big problems that open up new possibilities. Because if it's the same old stuff, if it's the same old tech, I don't think that we're going to go that far the next time that crypto becomes appealing on a macro basis to users and investors.
Interesting. Anything else to add to that?
I think the UX issue is one of the core issues to mass adoption. So it really depends, like, who's your target audience in terms of like the project. Are you looking at consumers or are you looking at developers? And so I think what's interesting is I was looking at wallets, and so social wallets where it's easier for people to, get a wallet, they don't get adoption. And so it's the UX, but actually, is it? Or what's driving the adoption of these wallets, et cetera? So I thought that was interesting.
Yeah.
So we can't take like the Web2 experience and just copy and paste it on Web3. We have to find a new solution,
right.
a new way to engage. So I think that will drive the next wave, but we're still in the bear market. So now everyone is like, the consumers are saying, is this real? Do I still want to buy NFTs and lose money? I don't know. So we'll see, I think, in the next 2 years.
I disagree with Haseeb. I'm going to walk through these. Okay, so on scalability, I think scalability is like a red herring. I don't think anybody really cares.
What?
Because
Why?
Well, you already kind of have two solutions. One is like the dollar amounts that are involved. Like, crypto is really optimized for not scalability. It's optimized for like seizure resistance and settlement and security. And so like I think it's important to improve the scalability, but like we already do, many billions of dollars of transactions, trillions of dollars of transactions a month without having to worry about scalability. So I think it's you can always improve it, but I think it's like not really the bottleneck. And then you have sort of hacky solutions like USDC, and you can do a bunch of stuff on exchanges. And so like I think a lot of what people want to do, it would be nice if we did it that way, but actually like that's not the real bottleneck. It's sort of like it will emerge despite the lack of scalability, I guess you could say.
Right. You're
like,
saying table stakes, essentially.
Yeah, like one good rule of thumb is like, even if you have a bad user experience, if you have something of real value, people will jump through hoops to get to the thing. Like the canonical example of this is Twitter. It's in top of the news, in the last couple of weeks. If anybody has been using Twitter for like 10 years, you might remember that 10 years ago, Twitter couldn't even keep their website up, right? The fail whale. And that thing is worth $40 billion. Like a website that they couldn't even keep online is worth $40 billion. So that's how you know you have product market fit. So like, I don't think scalability really matters that much. It's like, if you have something really of tremendous value, which is really what you should be looking for as a founder, then like, it doesn't matter that it's not scalable. People will jump through hoops to get it. Like the US dollar. A lot of people in the world want the US dollar. And as hard as the crypto user experience is and as like unscalable as it is and as clunky as it is, yep. There's $100 billion of that on chain, and there's all these people all over the world that are like clamoring for dollars, and they're jumping through a lot of crappy hoops to get to the dollar. And I think that's actually what we should be looking for as a founder. I could enumerate the others, but we probably have other questions to talk to.
Yeah, I mean, I think, and again, to Vanessa's earlier point, right, a big point of it is UX and scaling mass adoption, and obviously we're not there yet. So I guess, when...
Actually, can I make a point?
Yeah.
I think the other side of that would be, I think it's actually good, because we eventually have to solve those problems, but I actually think that if we made it too easy to use right now, that we would poison the well. Like, if you all of a sudden tomorrow had like 500 million people use crypto, probably they would all lose all their money. And then nobody would ever want to use crypto again. So I kind of think it's like probably one of the better things in the world for us to like not make this stuff usable for 3 to 4 years and like really like figure out security and like private key management and like, you know, fiat on-ramps and like mobile support. Like think about how you can't even use this stuff on mobile. Like, you know, and so like until a lot of that is in place, I kind of think like the friction to getting in should be high. And then like 4 years from now, we should like try to flip it on so we don't poison the well.
So I mean, to be clear, like the idea of, you know, hundreds of millions of people buying crypto and losing a lot of money, that happened.
Yeah.
Like we don't need to talk hypothetically about it. That's what happened.
Well, that's what I think. I think we have maybe one more shot. Like I think this cycle.
Last chance with retail.
Oh, I think there's just because then there's nobody left.
Okay.
All right, like. And so like then you like really set yourself back 10 years. So
yeah,
you know, I think this time we got like maybe 100, 200 million people in.
But look, what you're describing about usability, that like, look, if yes, even if the UX is bad, if people want it badly enough, they will jump through crazy hoops to do it.
Yeah.
That is what happened in the cycle.
That's right.
Is that you have, you know, TikTokers explaining to people how to like bridge funds into Avalanche or into Solana so they can go mine this like crazy yield farm or buy these NFTs.
Yeah.
People were doing all that stuff.
Totally.
They were doing all this stuff because they wanted it badly enough.
That's right.
And the UX was horrible.
Yeah,
lost a lot of people along the way.
Yeah.
A bunch of people lost their keys. A bunch of people got hacked. A bunch of people lost their NFTs, blah, blah, blah. And so we already have that.
Yeah.
We have the product market fit.
Yeah.
And we have the hundreds of millions of people using the stuff.
But wouldn't it be worse if 10x as many people had done that and lost the money?
I agree. Yes, totally. But a large part of what makes this stuff difficult to be used for other use cases besides the really speculative mania stuff is the fact that right now we can't at steady state do low-cost applications, right? Like Solana was falling over once a month. Ethereum fees were at $200 a pop just to do like a trade.
Yeah.
Like at that price, the only way that you can make anything work is with a true financial mania.
So I guess my question would be like, you know, is regulation, or I guess in terms of the 5 categories of unsolved problems, you would rank order them. And I mean, Haseeb, you would think that the UX to be solved last, right?
Wait, why?
No, sorry. I meant Avichal, you would rank UX to be solved last and have the 4 problems of scalability, you know, privacy, everything infrastructure related solved first in order to get us there. So that's really interesting. But I guess as investors, like, how do you then kind of build conviction around the products you're working on, right? Looking at market size, and how do you evaluate them in the context of those 5 categories, and you know, just build conviction that you want to make the investment.
Why don't you start first so I can disagree with you?
Well, we think about different categories. I mean, the market stuff, which is actually the most important thing we would normally look for. Like if we're a generalist VC, we would normally look at the market data. But in this case, we've sort of picked our market, right, by picking Web3, and so that's sort of accounted for. And so the sub-market, you know, are you pursuing payments? Are you pursuing, you know, like music NFTs? Are you pursuing, you know, the L2? Like there's those sub-markets. What we're actually looking at is like, why can that be really, really large? Then we look at, you know, the team, and we look at actually, are they capable of building this thing, which is really different than Web 2. Like in a lot of Web 2, the way that you have to assess an opportunity is, does anybody actually want the thing? Not can the team actually build it. It's like kind of straightforward to build a SaaS application on AWS these days, and the thing you're really asking is like, does anybody want it, and can you acquire the users? And here, I'm like, you know what, if you have like US dollars and you're giving away tokens, I'm pretty sure people will want that. But can you actually build the thing? Like, is it actually private? Is it actually secure? Can you actually like follow through on that? And so it's the way you assess is really different. The token economics obviously matter a lot. And then I think the thing that is usually the place where founders and teams in crypto will fall over is the go-to-market. Is like there's a tendency to do build it and they will come, where really like, you know, kind of what we were talking about this earlier this morning, right? Like Celo being differentiated in terms of the value system is actually the customer acquisition strategy and is the retention strategy. And you have to be, you know, very, very, very clear on your values in order to be able to acquire customers. That's, you know, ultimately the defensibility is like that in-group versus out-group dynamic, right? And in order to do that, you have to believe things that other people don't believe, because that's how you create an out-group. Like you can't have an in-group unless there's a set of people that believe something very different than what you believe. And that's usually where teams actually will struggle. So like all the like product stuff that you were talking about, the 5 barriers, I think is really important. Yeah. And those are necessary, but actually in our experience, usually the place where teams fall over is that last one, which is, okay, well, you could build the thing, but like, what do you actually believe, and how are you actually going to get customers, and how are you actually going to get people to continue to use it when the bear market comes, and like, what is your value system? And usually people are not that thoughtful about it.
Vanessa, I'd be curious to hear like how you and your team are thinking about that as well, and just
So I would
evaluating.
say the team is the number one criteria for us, and then we try to look at each subgroups and say, okay, what needs to be true for this vertical to succeed or this area to succeed, and what is the stack that's needed, and where does the value accrue? So that's how our mental framework goes. But if you don't have a team to execute, you have nothing. And we've been in the space for a while. I come in very early, like pre-seed seed. So like part of our assessment on the team is, what they worked on before, have they delivered? We see a lot of second-time founders now in crypto, which is pretty exciting, and people from Web2 coming in. But do they really understand their stuff? Are they deep? Are they going to be able to deliver technically? The thing is really what we're looking for. They can always pivot. We can always help them after with go-to-market and all that stuff. And, it's usually 2 or 3 people starting.
Right.
So we're not worried about the rest.
Yeah, because there's this concept of having like Web3 crypto natives and evaluating for that, but it's still such a nascent space. I mean, how true is it that you can invest in all the Web3 crypto native folks when you're looking to onboard more Web2 development talent and expand that pie, right? So how do you think about that?
Well, I'm going to respond first to Avichal because almost everything you said was bullshit. So first thing I'll say is team is overrated. I think if you look at the VCs who index way too much on team, they tend to back very impressive founders who have all this great pedigree, have built great stuff in the past, they exited companies, and almost none of them have ever done anything in crypto. Like they've all raised money, but almost none of them have actually accomplished anything meaningful in crypto. If you look at the people who have really accomplished things in crypto, it was some crazy online person named Satoshi, Vitalik, who was like a 19-year-old when he came up with Ethereum. Look at Hayden, who founded Uniswap, who was like a rando who'd never even coded before he built Uniswap. Almost everything that's really amazing that's been built in crypto was built by a freshman. It was built by someone doing it for the first time, who would not have been backed by Sequoia or by any of these stalwart funds that are looking for great teams. That's what primarily you talk to them. They're like, we're looking for the best of the best teams. None of those people have built the great things in crypto, and so I think, from my perspective, what's more important than team is product. And you said earlier that building it will come is a big mistake in crypto. It's all about go-to-market. I think that's not true. In fact, I think again, most of the best things in crypto were build it and they will come. So if you look at Ethereum was build it and they will come. What was the go-to-market for Ethereum, right? There was barely a go-to-market. I mean, there was a bunch of kids. If you look at Uniswap was literally build it and they will come. DeFi, the term DeFi wasn't even coined when Uniswap was created. Solana, they built it and nobody cared for the first 6 months until Sam found Solana and made it into the thing that it is today. And all the things that did amazing BD, amazing go-to-market, amazing community building in 2021, particularly in DeFi, are almost all dead. None of them ended up building anything of substantive value.
So I'm going to disagree.
Boom.
Okay, all right.
2 against 1.
We've got a three-way going on now.
Having been part of the
we got a cycle.
Ethereum
This is why we do these sessions.
go-to-market. So I came in very early at Consensus. And think of Consensus as the marketing arm of Ethereum, as a separate company.
Yeah.
Building
That's a great
developer
point.
tools. And I realized that after leaving Consensus.
Where would Ethereum be without consensus, Haseeb?
The amount of money that was poured into the narrative of Ethereum when there was no one else was impressive. So they took the market and they kept it. And they've kept it because of also technical aspects around security, et cetera. But, at a time when you needed to inspire devs and pull them together on a shared mission, alongside Vitalik, there was this marketing arm and this branding arm and this advocacy arm that was Consensus. And I think people forget that and how long it took to do that, because right now we're playing the model for all their L1s, but the time is compressed. You don't have 5 years, right? You have 2 years to be successful. So it's I think we're at a different stage for this go-to-market strategy, and we have to think a bit creatively about how you do that and how you bring developers to your ecosystem.
So that's actually a really good point. I want to pull on that thread a little bit. In go-to-market, right, obviously Web3 business models are notorious for not having a way to fully monetize. I mean, obviously you have Uniswap that, gives fees to LPs, et cetera. But like the core protocol and the folks who own the network, how do you see that those business models evolving to capture real revenue? And I mean, ultimately a lot for investors, that's, what a lot of folks care about, right? So how do you see that, well, where is that today and where do you see that evolving?
So I think we still have issues around regulation about how you capture value with the token, right? So we need to get out of this governance token cycle.
Yeah, I don't know that anyone on stage is allowed to talk about this.
No, but there's constraints on the regulation side that makes you shape tokens the way they are. And if you receive money for the development of the company, then you're in trouble. So I think we need to think seriously about how the value accrues to tokens and what are the mechanisms to allow for that and who are the users. Because I think if it's developers, if you're contributing to you're staking or you're doing stuff for the project, that's one thing. But when you have projects that aim at and target consumers, then we're in a different situation. So.
Yeah, this is unfortunately one of the dirty open secrets of the industry, is that everyone knows what the tokens should do. The tokens should capture some kind of surplus from the protocol and give it to token holders, right? Everyone it's obvious what they should do, but they're not allowed to do that. Because if they do that, they become securities, and Mr. Gensler gets very upset. Why are you making all these securities and selling them to retail investors? And so, so you have these gymnastics that everyone is doing, like us on stage doing these gymnastics to try to avoid saying the thing that's like the obvious thing. At the end of the day, the tokens that you see actually doing this are mostly the tokens that are not under the aegis of the SEC, or that are already so plausibly decentralized that they can escape from that game. So like Sushi was probably the first and most obvious example. They just took the protocol surplus and gave it to token holders. And it was really obvious. Everyone understands Sushi. It's really straightforward. There's no real question about how it works or what the mechanics mean or whatever. Almost everything else we kind of have to talk out of the side of our mouths about, it's a governance token, that means you can govern it, and governance is good because everyone loves to govern things. And it reads a bit shallow, and I think there's just a stage of crypto and regulation and where we're at. I don't know what more there's to say about it.
Yeah, no, I think that's really interesting. But as an investor, right, do you think the only exit path or liquidity option for your portfolio companies are through tokens, or is there also the equity component or some creative way? Because as fund managers, you have to return capital to your LPs. So how do you think about that in that model?
I mean, it just depends on what you're building, right? So if you're building a centralized exchange, then yeah, don't do a token. Like, that's a terrible idea. If you're building a network, yeah, don't build a company. That's a terrible idea. So now there's always some mushy space in between that's like, there's a little bit of centralization, but it's pretty networky and decentralized. And there are also times when the attractiveness, to be honest, like for a lot of founders, it's just the practical question of what can I raise money for?
Yeah.
And so it's like, okay, well, doesn't seem like anyone wants to buy equity right now, so I'll guess I'll throw a token on that. And turns out, voila, they get capital. And so a lot of this is just the incentives that are coming from what investors want. For our purposes, and I'd imagine for everybody on stage, what we look for more is that there's some coherence between what you're building and how you're monetizing it. That's mostly what I care about. I don't really care. I'm happy to back a centralized company. I'm also happy to back a decentralized protocol. But the way that your protocol or company captures value better make sense. If it doesn't make sense, then I don't want to back it, even if I think the underlying thing is decent.
Yeah. Avichal, would you agree with everything you just said?
I have to reluctantly agree with that one. Yeah, it's sort of.
That means
I think the instrument is sort of a secondary thing. It's more like, are you doing something that creates real value, first and foremost? And if you have real value and real utility, there is undoubtedly some way to capture that value. And then there's a whole bunch of questions around what that mechanically looks like. But those are all solvable problems. And actually, despite the sort of mushy middle, I think there's an increasingly clear path to being able to say, is it equity or is it tokens and starting to bear out. It's something I've been thinking about. Like, I think at some point we're going to need to start quantifying it. But I think for now it's sort of I'll know it when I see it kind of situation.
Yep.
And like Ethereum is clearly decentralized, Bitcoin is clearly decentralized. And so I think you can look at some of these things and say, sushi, and you're like, it's like, probably to me that is clearly decentralized. So I think we're starting to build some intuition around these things, and over time we'll quantify them, which will make this a lot easier.
Let me ask the two of you a question. What do you guys think about the trend of issuing both equity and tokens, but not selling them at the same time? So different equity holders, different token holders.
I kind of don't like that. I like to have both because if in the equities there's staying power with the teams, they are going to be capable of issuing other tokens, of being creative in the future, and we're going to have like these kind of holding entities that issue tokens and different projects, et cetera. So I want to keep oversight of the equity, where and see the tokens that correspond to the projects that they're launching, and being able also at the beginning to help them shape those projects.
Yeah, I mean, it's good for the investors are sort of playing this game where they get to participate in both right now. It depends. It goes kind of back to what we were talking about before. I think it really depends on the circumstances. Like if depending on what you're building, it may make sense to have both. In many cases, it does not make sense to have both. You kind of want to pick one or the other. So I think it's sort of a facts and circumstances kind of situation.
So I'd like to pivot it into a bit more about a investor's direct role into supporting a lot of these companies. Tokenomics, big topic of it. Obviously, segueing from what we just talked about. But where do Web3 crypto investors, where can they add most value? Because I would argue for Web2, you have the whole traditional hiring, go to market, a lot of those strategies, and sure, there's overlap there. But there's a lot of like Web3 native ways that are really not as expansive, or at least not everyone has knowledge about it. So how would you, say that these investors support or should be supporting portfolio companies?
Honestly, it's not that different.
Yeah.
Like the way in which you provide value is a little bit different because there's different kind of partnerships, different kind of hiring, different kinds of strategy.
Yeah.
But fundamentally, the relationship between an investor or an advisor and entrepreneur is kind of the same regardless of what industry they're in. So I think we kind of do a lot of tap dancing to try to convince people that Web3 is so different, it's blah, blah, blah. In reality, I think it's specialized, right? There's different kinds of ways in which you need to add value in Web3, but they're more a difference in kind than a difference in quality.
I disagree.
Let's hear it.
Go on.
I think it's pretty substantially different. I mean, it's sort of like, it's like 100,000 foot view. Capital increasingly is a commodity, and so you need to differentiate that capital. And from a founder's perspective, probably the most important differentiation ultimately is brand, because success begets success, and so like what the investor is really giving you is their brand. But the kinds of services that a crypto VC needs to give you in order to support your endeavor is just so fundamentally different than a Web2 VC, that you then end up having to build your organization very differently. And that's why I think if you look inside the crypto VCs, the ones that are the most successful and that have actually achieved some scale, they look a lot more like software businesses than they do traditional VC businesses. Like traditional VC is actually a financial services business. It's a consulting service with like some brand layered on top. So it looks a lot more like a Goldman Sachs. The modern crypto VC looks a lot more like a startup because there's a sort of whole rant I have on this, but I think if you sort of buy this idea that crypto is software eating money, and therefore crypto is going to eat all of the capital flows of the world, it's going to eat venture capital. It's venture capital is just one form of the capital markets in terms of capital deployment. And when you look at other industries where software eats that industry, startups win. Like the incumbents tend to lose, and the startups win because you have to retool your organization. So like, why does Tesla beat Ford and GM, or why did Amazon beat Walmart, or why did YouTube beat any of the TV companies? It's because when you look at the legacy business, the people who have power inside that organization are different. And inside the startup, the people who have the power are the engineers and the product people and the designers, because that is your critical lever to winning, is building a better product and getting it to market. And so at Amazon, all the engineers make all the decisions, and they make way more money than the partnerships people. And at Walmart, the biz dev people that have the relationship with Procter & Gamble make a lot of money, and the engineers don't. And in fact, the engineers very well may roll into the chief information officer. They don't even have like a CTO, CPO sort of a thing. And they might be called IT. They may not even be called software engineers, right? It's just like the culture is totally misaligned, and Walmart has had 30 years to compete against Amazon, and they're still not able to. So to bring it back to crypto VC, I think if you look at the modern crypto VC, internally they look very, very different. Like they have in-house engineering teams, and they build stuff, and they sort of support you differently. So the ability to run validators, the ability to provision liquidity, the ability to vote on governance proposals, the ability to support in that way is just so different. Do vote escrow lockups. Like there's all of this stuff that actually looks really, really different internally. So yeah, I actually think it's pretty, and which is why you don't really see many of the traditional Web2 VCs being able to come in and do this. This is very, very similar to any disruptive market where the incumbents have a very, very tough time disrupting their own business model. Like, are the partners at Benchmark going to blow up their business and say, like, cool, I won't take all of the carry. We should really have a 15-person engineering team, and let's make sure those people get like half the carry? That's just not going to happen. Like, why would they do that? They have an amazing business. They're all billionaires. Like, why would they blow up their own business to do that? And so that creates space for the Web3 VCs to come in and just retool the business, and it ends up looking very different as a result.
So Vanessa, I know you've seen the best of both worlds, because at CoinFind you did a lot of portfolio support and helped a lot of companies go from 0 to 1. What are your thoughts based on what Haseeb and Avichal shared?
Yeah, I agree. The technical capabilities are really a differentiator. It's just something on top of what traditional VCs do. And I think with the hyper financialization of the Web3 in the past 2 years, we've seen a lot of market makers come in. We see liquidity being top of mind and market infrastructure being top of mind for companies that are launching tokens. And that's a really important part of your job as a founder when you're going to launch a token, is really think about that and think about bringing in the right VCs and partners who can provide liquidity and really have you create a vibrant community and trading. So I think that has changed, and the capacity of running node, decentralizing your project, and also voting on governance is really important. Now, a lot of VCs say they do that. They might not actually do it. It's a big pitch for VCs. So look at the ones that really deliver on what they promise.
Look, I hope you all realize here that I'm breaking VC protocol by telling you all the truth. This is Web3 propaganda that's going on right here. I'm telling you guys what's really going on.
Love it. I honestly can go on and on for hours on this, but we only have a few minutes left. I'd love to open it up to the floor for any questions. Go ahead.
As a DApp that's in the process of doing some of these token gymnastics, are there any DApp tokenomics that you think we should model ourselves after, like that manage that?
I'm sorry, actually. Here, let me hand you a microphone.
Yeah. Oh, that's good. That's better.
As a DApp that's working to do some of those gymnastics with regards to designing tokenomics, are there any projects that you think have managed that well and should be something that we should look after?
Yeah. So the question is like, are there tokenomics that you should model your tokenomics on? I've said this publicly before, is that I think tokenomics is overrated. If you look at some of the most successful things in crypto, their tokenomics are kind of shit. Like, what is the tokenomics of Solana? I don't really know. Like, doesn't really seem like anything. What's the tokenomics of Uniswap? Nothing. Literally, there's no revenue capture or anything. The fundamental thing that matters is building a good product and solving a big problem. And if you do that, it's kind of like any tech company, right? Like, I mean, Facebook, for a long time, people were very confused that, like, how is Facebook ever going to make money? It's just a bunch of eyeballs. Turns out Facebook is one of the best monetizing businesses in tech history. For the most part, the thing that matters is solving a problem. So I don't have a great answer in terms of like what particular, I don't know anything about the product you're building. So it's hard for me to give tokenomic advice. But overall, I'd say one of the big lessons of the last couple of years is that tokenomics matters a lot less. It doesn't matter very much in the long term. It matters in the short term. Short term, there's a lot of crazy shit you can do with wild enough token economics. But in the long run, the thing that ultimately matters is solving a problem.
Thing I would add to that is I think it's hard to point at examples of great token economics, and I think it's just going to take a long time to sort of see what happens and how these incentives play out over multiple cycles. There are definitely bad token economics, and so I think it's easier to find examples of like don't do that than there are to say definitely do that. And so that's one thought. Second thought, which I think is really important for anybody that's building in this space, is it's important to recognize that your token is not your business model. Your token is your customer acquisition strategy. And too often people make the mistake of thinking that the token is the business model. And I think if you sort of mistake one for the other, that's where you can really blow yourself up. And I think if you think of it as kind of what Haseeb was saying, is like fundamentally there needs to be value creation, and fundamentally the unit economics of the thing that you're creating need to make sense, and then token economics can juice that fundamental value and that fundamental unit economics by bringing in, by driving down your CAC, your cost of customer acquisition. But if you sort of conflate the dropping cost of customer acquisition with your business model, that's where you really blow up.
Well, thank you for that. We are right up against time, so please give a round of applause for our speakers here.